Good afternoon, everybody, and I say good afternoon, and I apologise for doing this briefing later than normal today. I've been a little bit under the weather, not feeling well at all, so I've just been catching up on a few Zeds, which is why it's coming a little bit late today. So if we looked at the markets last week, we seem to have another awful week. We had the Dow down 1.6%, the Nasdaq down 5.4%, the FTSE down 3.9%, the Nikkei down 4%, and the bundle of four, which I nearly always say seems to outperform the market or doesn't do as poorly as the market, unfortunately did worse, with a loss of 6.7%. That said, though, I did read the other day that Apple, Microsoft, Facebook and Google are the four largest cap companies in the world now. What with the oil price being so low, these technology companies, have taken over as the largest companies in the world. We also saw a falling US dollar. We saw the dollar fall 3% against the euro. It's now at 1.11. We saw a 1.8% fall against the British pounds, so it's at 1.45, and we saw it fall 3.4% against the Japanese yen to be at just under 1.17. It remained fairly stable with the Chinese yuan trading at 6.57. Yes, these markets are scary places to be, and when you look at companies like Facebook losing 9.2% in the week last week, that is a scary number. But why is this actually happening? I mean, Obama announced the other day that the US had recovered from its worst economic crisis since the 1930s. Yet unemployment fell to less than 5% for the first time since February 2008. Now, these are all indicators that the economy is in a good shape, not in a bad shape. Yet the markets and the emotions of the markets don't necessarily reflect the reality of what is happening there. And whilst I usually leave the quotes till the end of my briefing, I think it may be an opportune time now to bring in a quote from Benjamin Graham, who was one of Warren Buffett's mentors in the 1950s. And one of his sayings was, "An investor's worst enemy is not the stock market, but his own emotions." And this is what it is, the stock market is an emotional place. People buy and sell, people get scared, people get nervous, people get excited. And because of that, you see the volatility existing. But you buy into good companies and you're willing to invest for the long term, you'll be fine. And of course, you've got your yield as well. Another theme that I've been talking about recently, and some of you may know I've been interested in investing, is India. And there was data out today saying that they expect the Indian economy to grow faster this year than China. I think the number was around about 7.8%. One of the major reasons for that is due to the fact that India imports over 80% of its oil, so therefore it's benefiting from this low oil price, which many believe is going to be around for many, many years to come. The days of 60, 70, 80 or even $100 barrels of oil are gone in many people's opinions. And if we see it bouncing around between the sort of 20 and possibly as high as 40 over the next decade, then I think that's probably about the status quo. So this weekend on the sporting fields, we had the start of the Six Nations. It's a very interesting competition now, insofar as even Italy, who used to be the whipping boys, are competitive, and in fact any team could win. England got off to the best start with a win over the Scottish, and there was a draw with the Welsh and Irish, which was a terrific game. So looking forward to the rest of the games for that. Sorry it's a little bit short today, and sorry that perhaps I'm not sounding too great. As I say, I've been a little bit poorly, so I'm just going to finish this up, do a little bit